You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I just want to talk to you about basically how when you have an investment strategy that you are very high conviction on and you want to stick to, you're going to have a lot of naysayers that approach you and basically try to bring your conviction towards your own strategy down. They're going to tell you that investing in dividend growth stocks isn't going to help you achieve financial independence, or you have to invest in this marijuana stock that their family member recommended, or there's potentially a mining company that's going to go to the moon. So they're going to tell you to put their money, or to put your money, however, into those funds or to those shares. Now, people, especially when they're uneducated on why you may be doing your strategy, i.e., passive growth dividend investing, they're going to not understand the concept of getting rich slowly. Now, getting rich slowly basically is a method that you use to take out some of the volatility of investing. You're looking to basically consistently put money into the market every single month into an index fund that is low in volatility but high in returns, averaging around to that 8% returns per annum. Now, you're going to have people that are like, oh, you should have put your money into Bitcoin because, with hindsight, yeah, that would have achieved some amazing results. But also there would be points of time where your heart would be broken by the amount of paper losses you could have had. And what's to say that given that moment you would have sold or would have held on? We don't actually know what happens until it happens. So it's very important that when you are making these investments, you understand your strategy so that if somebody does try and say to you, oh, what about investing into Afterpay when it was $2.50, or why didn't you invest into Facebook when it IPO'd? There's no way of knowing which companies are really going to take off. And a lot of people that have successes in these companies, it's based on luck alone. You may not be willing to, gamble or roll the dice in order to find these one-off companies, because it may take you 100 buys in order to find that unicorn. So I highly recommend figuring out your strategy. And then if somebody says, oh, how long will it take you to double your money investing in index funds? You can tell them, every 7 to 10 years, that's likely to happen based on the annualized returns of around about 8 to 10%. However, if someone's asking you what the share price is in the short term, you can just say, I don't know, I don't care. Why? What are you going to do if the market drops 10% in value? I don't know, I don't care. Except you do know, you're going to add more money in. There's a very powerful psychological benefit to not selling in those short-term dips and to actually buying. Yes, everyone may call you crazy, but if you manage to keep adding your money into the market, you're going to come out on top. In the long run, having lots of buy and sell orders is not really going to be so handy, easy to manage, and it's not going to let you sleep at night. If every time you add money into the market, you understand that you are not going to access it, and you're just simply going to let it sit there for the long term, 10, 20, 30, 40 years in a low cost, high yield index fund that's highly diversified, you're going to come out on top. There's almost no chance of you losing all your money to zero, because no matter what, that index fund will still hold companies that are making profit, that own assets, that have employees and intellectual property. So there will always be some sort of cash flow. Even if the performance goes down, there will always be some sort of cash flow that index fund or ETF is creating. Now, it's very important that you don't let people make you question what it is you're doing. So you don't want to have those moments of doubt, or what if they're right, If you tell somebody that you don't care what their opinion is and you're just going to continue doing what you are doing anyway, they're going to not really understand where you're coming from. They may also find that you're a little bit crazy, but hey, being a little bit crazy is far better than the alternative of being a little bit broke. So if you keep to your strategy and you don't change it at any sign of media hype, anytime somebody at a barbecue says you should have invested in this stock, etc., you're going to be better off, because you are following strong long-term investing principles of dollar cost averaging into the market as often as possible and as much as you are comfortable investing. And that's very powerful. Now, when it comes to actually Now, when it comes to actually investing in the share market, obviously the short-term volatility can be a bit unsettling for people. So making more regular investments than one lump sum investment can be far easier to stomach, because you know that over the term of 12 months, if you've invested 12 times, you're going to sort of balance out all the different highs and lows that the market has achieved in that time, and you're going to have a fairly decent cost basis for the shares you hold. If, however, you take everything that you would have invested over the course of a year and just lump sum dump it into a particular index fund in one go, and then that market drops, 20-30% in the next month, that's going to really stress you out, because you've deployed all of your funds. You're going to then realize, I could have actually got far more had I held off 30 days, or, had I held more cash, and it's going to stress you out a little bit. So in terms of the psychological benefit of being able to sleep at night, dollar cost averaging makes a lot of sense. You don't want to have an investment strategy that causes you anxiety and stress, because it's highly unlikely you will stick to it for the long term. And when it comes to researching stocks yourself and, being an active investor, that just adds another layer of stress to the equation. It's very difficult to go about your business every single day, week, year, month, if every decision you make has vast impacts on your portfolio, whether positive or negative. So let's just think about this for a moment. If you had, say, $10,000 and you put in $1,000 into the share market 10 times, you're likely to not have any sort of price fluctuation that will really stress you out, because let's say that market does drop 20%, the next time you put $1,000 in, you're going to have essentially 20% more buying power, okay? So we could look at this like the shares are actually on a little fire sale, and that's going to mean you get more for that same dollar value. It's deflationary in that way. Now, if the market has a nice rise and it goes up 5% in a month, you're just simply going to put that next $1,000 in, and yes, you'll buy less with that you'll buy less shares with that $1,000, but you're going to end up with more shares in your portfolio, even though you weren't able to purchase as many with the same money. So as that rise is occurring, you're capturing some of that on the way, so your money keeps compounding. When it drops, yes, you'll have a paper loss, but if you are extremely diligent and resilient and you don't sell, you're going to keep growing your wealth in the long term. Now, there are many studies that show that lump sum investing can actually be the best option, especially for those few who manage to time the market right and they buy in, and then it's on a nice bull run for months or years afterwards. However, the likelihood of you picking that and getting the timing absolutely perfect is very low. And I must say, there are many analysts, professionals, and even artificial intelligence programs that cannot pick when to buy and sell shares and index funds at exactly the right time. So unless you actually think that you can outperform all the smartest people in the world, it's highly unlikely you will too. That's why a regular investment strategy where you dollar cost average a particular amount in every single month, as much as you are comfortable investing, and you understand that in the short term it could be quite volatile, but in the long term it will grow, that is the psychologically strongest approach and strategy to take. Because at the end of the day, you want an investment strategy that allows you to still go out and live your life. You want to not, pull your hair out watching the stock market drop in a single day because you had all your eggs in one basket. Although some of the best active investors in the world recommend having all your eggs in one or two baskets and watching it closely, I must say, for the average person that doesn't do a very thorough and sound analyst of stocks, you're far better off not taking this approach and just investing into an index fund, a listed investment company, real estate investment trust, or something that's already diversified in one trade, has a decent dividend growth, and also is very low cost in fees. Like I've talked about before on this channel, fees will absolutely destroy your returns, especially in a negative market. Those fees give you an even lower return or a worse return because your money goes backwards. So if we can keep fees to an absolute minimum, that's not going to white ant the effort of our gains too much. It's going to allow more net worth to compound over time, and we can capture some of those gains. So just remember, guys, anytime somebody tries to criticize your investment strategy, or they ask, what if you invested in this? What if you did that? It's very difficult to know exactly what approach you would take given the different volatile times in the market. Had you had your money in a company and it doubled, would you really have held on to that money and then ridden it out until it went up 10x? Or would you have freaked out that you had such a good gain and sold once it was up just 100%? So, there's a lot of what if scenarios when people talk about this and try to question you on your strategy, and also try to sound more intelligent by belittling your strategy. Just ignore it. Tell them, I don't know, I don't care, every single time. What if you bought Bitcoin in 2009? I don't know, I don't care, because I didn't. What if you bought Amazon in 1999? I don't know, I don't care, because I didn't. What you know is what you are doing right now, and that's the returns that you're getting on the index funds that you're holding long term, with the idea that you will get rich slowly, but you will not lose all of your wealth overnight. Even though your portfolio may halve, it will pretty much never go to zero. Now, obviously, I'm not a financial advisor, but as far as investment advice goes, sometimes the most complex strategies are the hardest ones to adhere to. They're the hardest ones to actually make real wealth off, and quite possibly they're the ones where you will panic sell. So if you have a simple investment strategy, you have a high conviction on it, and you're extremely passionate about continuing that strategy in the long term, regardless of what happens in the next month, 2 months, 6 months, it doesn't matter. What really matters is 10 years, 20 years, 30 years. And I recommend that you take the same approach when it comes to investing, because the longer we have our money in the market, the better the returns are. You will ride out any flat periods, any dips in the market, and you will capture all of that growth as it occurs. Especially with dividends reinvesting, if we have dividends paid to us and the market dips, we're going to be able to have our dividends buy back in automatically, but it's going to be at a discounted rate. So even though you may have bought your initial shares more at a higher price, the dividends could get reinvested at a lower price. So you're essentially averaging down with those returns, and then as the market picks up, you have more shares growing in value. I highly recommend using your dividend reinvestment plan if you're looking for a passive investment strategy. Alright guys, that's the video for today. Now obviously this is a bit long-winded, and I'm talking about a few of the principles that I have mentioned before, but I just don't want you guys to become a victim to the noise. Make sure that you follow your strategy and you do what is best for you, not what is best for someone else. Now, if you got any value from this video, please like, share and subscribe, and leave a comment down below as to what your investment strategy is, or what sort of crazy stories people have told you. I'd be very interested to hear that. Now, I really look forward to seeing you in the next video.